Is a recession coming to the US? The early 2020 pandemic recession was the shortest on record in the United States. The question now is, how long the post-pandemic economic recovery will last, and whether we are on the verge of another recession. What is a recession? Before we go on any further, let's start with the basics. What is a recession? A recession is a macroeconomic way of referring to a significant drop in overall economic activity in a specific geographic area. It had previously been defined as 2 consecutive quarters of economic collapse as measured by GDP and monthly indicators such as an increase in unemployment. The National Bureau of Economic Research, NBER, which officially declares recessions, mentioned that that's no longer the case. A recession, according to them, is now defined as a significant decline in economic activity that lasts more than a few months and is visible in real GDP, real income, employment, industrial production, and wholesale retail sales. What happens when there is a recession? So what happens when there is a recession? People from various economic backgrounds will feel the effects of a recession in different ways. Some broad trends will emerge, including the rise of unemployment, contracting of GDP, and the stock market will suffer. What causes recession? Several economic theories have been proposed to explain why and how the economy might deviate from its long-term growth trend and enter a period of temporary recession. These theories are broadly classified as being based on real economic factors, financial factors, or psychological factors, with some theories bridging the gap between these. Some economists believe that real changes and structural shifts in industries are the best explanations for when and how economic recessions occur. For example, a sudden sustained increase in oil prices due to a geopolitical crisis may raise costs across many industries at the same time, or a revolutionary new technology may rapidly render entire industries obsolete, triggering a widespread recession in either case. The spread of the pandemic and the resulting public health lockdowns in the economy in 2020 are examples of the type of economic shock that can cause a recession. Other underlying economic trends may also be at work, leading to a recession, and an economic shock simply triggers the tipping point into a downturn. According to some theories, recessions are caused by financial factors. These typically focus on either the overexpansion of credit and financial risk before the recession, the contraction of money and credit at the onset of recessions, or both. Monetarism, which blames recessions on insufficient money supply growth, is an example of this type of theory. The Austrian business cycle theory bridges the gap between real and monetary factors by investigating the relationships between credit, interest rates, market participants' production and consumption plans, and the structure of relationships between specific types of productive capital goods. What is the distinction between a recession and a depression? Although the causes of recessions and depressions are similar, the overall impact of a depression is much worse. There are more job losses, higher unemployment, and steeper GDP declines. Most importantly, a depression lasts longer, years rather than months, and it takes longer for the economy to recover. Economists do not have a standard definition or set of measurements to determine what constitutes a depression. To put it simply, the effects of depression are more profound and last longer. The United States has only experienced one depression in the last century, the Great Depression. What is going on? Now that we have a better picture of what recession is all about, let's answer the big question. Is a recession coming to the US anytime soon? But before we continue, go ahead and click the subscribe and like buttons. It takes a lot to make these videos. Your small actions tell YouTube to keep promoting our videos. Also, tell us in the comments section what you think is the best way to cope with a recession. Thanks. Now back to the video. The Federal Reserve started raising interest rates for the first time since 2018, from 0.25% to 0.50%, and proposed that the federal funds rate could reach 2.5% or higher by the end of 2022. Fed economists lowered their economic growth projections for the year in forecasts released alongside the rate decision. The preliminary estimate of the first quarter gross domestic product, GDP, in the United States was negative 1.4%, raising concerns that a recession may be closer than many had thought. Meanwhile, high inflation is dampening consumer spirits, and Russia's invasion of Ukraine has pushed up global oil prices. Why are analysts concerned about a new recession? The major changes in the Federal Reserve strategy are perhaps the most concerning to experts who predict a possible recession. After downplaying inflation for much of 2021, the Fed has finally found faith in terms of controlling price growth. The Fed began preparing markets for tighter monetary policy in January, when Fed Chair Jerome Powell stated that the central bank's $9 trillion balance sheet would be reduced sometime in 2022, and the process of withdrawing cheap money from the economy would begin. This puts pressure on stocks across the board, particularly high-flying tech firms that thrive in such conditions. Powell took the next step by not only raising the federal funds rate, but also indicating that there could be up to 7 rate hikes this year. According to Goldman Sachs, the Fed will be even more aggressive in upcoming meetings, raising rates by 50 basis points rather than just 25. Powell also stated at a conference in March that the central bank must move expeditiously to raise rates in order to keep inflation expectations from rising further. Inflation assumptions are simply people's beliefs that prices will rise in the future, and they have a slew of consequences, such as accelerating wages, that can make it even more difficult to get inflation back to the Fed's target of 2%. At first glance, the Fed's strategy appears to be pretty sensible. The Consumer Price Index, CPI, has reached 4-decade highs. Some are concerned that after downplaying the rate of inflation in 2021, remember, transitory, the central bank will be too eager in raising borrowing costs. Given the high rate of inflation, particularly in oil and food, it's easy to imagine consumers cutting back on spending to compensate. While the Fed is raising interest rates in order to drain some of the economy's spending, economic growth could be stifled if consumers remain too quiet. How does a recession affect you? Why are we talking about all these things? It's obvious. Anything that's happening to the economy will always have an impact on end consumers. During a recession, you may lose your job as unemployment rises. Not only are you more likely to lose your current job, but it also becomes much more difficult to find a job replacement as more people lose their jobs. People who keep their jobs may see pay and benefit cuts, as well as difficulty in negotiating future pay raises. During a recession, investments in stocks, bonds, real estate, and other assets can lose money, reducing your savings and upsetting your retirement plans. Worse, if you are unable to pay your bills as a result of job loss, you may face the loss of your home and other property. During a recession, business owners make fewer sales and may even be forced to declare bankruptcy. The government tries to help businesses in difficult times, such as the PPP during the coronavirus crisis, but it's difficult to keep everyone afloat during a severe downturn. With more people unable to pay their bills during a recession, lenders tighten mortgages, car loans, and other types of financing standards. In more normal economic times, you would need a higher credit score or a larger down payment to qualify for a loan. Even if you plan ahead of time to prepare for a recession, the experience can be terrifying. If there is a silver lining, it is that recessions do not last indefinitely. Even the Great Depression ended, and when it did, it was followed by what was arguably the strongest period of economic growth in American history.